Good morning, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer. And let's welcome Dimitri Pargamonic to the stage. How you doing, D?
Good morning, Will. How are you?
Good.
Morning, everyone. Let me share my screen here.
Today, we're going to look at how to use the stock screener for relative market performance, correct?
Yeah, let me go to the screener first so we could look at what we're talking about. And on the main menu up top, click on screeners, hit stocks, and this will take us to the stock screener. And in this example, what we'll do is look for stocks that have a relatively strong performance in relation to the rest of the market. And what I'm going to do is slide over. We have different tabs with analytics. We're going to slide over and click on this average daily stats. And now that we're on here, what this particular table is doing is looking at price performance of the stocks based on average daily returns. And the idea there is, well, we could have a stock, let's say in the last 2 weeks, that had a very big, let's say, return, very spectacular day. And after that, it kind of let's say it stays flat or even goes down a little bit. Well, that 1 day event will skew the whole for that 2 week performance based on that 1 day's activity, which could have been just a one-time adjustment or event for something, maybe like a, some kind of announcement, lawsuit. And this looks at it from a little bit of a different perspective and acknowledges, okay, that could happen in any stocks. How do we kind of smooth that out to see on a daily basis, how does the stock perform relative to the market? Okay, so what if you had, one excellent day, but all the other days looked weak? Well, that gives you a little bit of a different information. So here, what we have is a table that looks at the last 15 days, 15 trading days, last 30 trading days, and last 90 trading days. And instead of looking at the performance of the stock, let's say, from one reference point to another, it looks at daily returns. What did the stock do today, the next day, and then it averages them out. So this kind of smooths out, maybe any like really big one day move. So on a daily basis here, what we see is, for example, Microsoft, in the last 15 days, 80% of those last 15 days were positive, up days. 20% were down. The average of all the returns, so if we took all 15 days and we, took each return and then averaged them out by 15, was positive 0.4%. Okay, so the returns were still positive on an average, 0.4. When we average out daily returns. Then we get the standard deviation of those returns, and that lets us know, well, in the last 15 days, how volatile was the stock? We could get to 0.4% on an average day, but, was it consistently there, or did it move around and just happen to average out to 0.4? That tells us the standard deviation of their returns around the average. So how much variability. And then to get a sense of the the average return divided by the variability. We take the Sharpe ratio, which is the average return divided by the standard deviation of those returns. So we get this Sharpe ratio. So now we could kind of compare things, across the board, stock versus stock. Right now we could look at NVIDIA, Apple, and so forth. We could also go longer term or shorter term. We could see, well, how does it, let's say we take the last 15 days. So that will, let's say we consider that the most recent history. Well, how consistent was that over a longer period of time or an intermediate period of time? So then we expand it to, let's say, 30 days. So now we could compare the 30-day versus the 15-day, which looks like in the most recent history, it's been actually improving. And we could compare that to the last 90 days. So even in the last 90 days, we see average returns are positive, but there were 58% of the returns were positive versus in the last 15 days, 80%. So it's actually gotten even improved here over time. Okay, so these are when we think of average returns, think of if you reset your risk at the end of each day. Okay, so let's say if you wanted to manage a risk portfolio that did not risk more than $1,000 worth of stock in Microsoft on a daily basis, well, at the end of each day, depending on where the stock is, you would have to either sell shares or buy shares to get it back to a $1,000 notional or $10,000, whatever you want, notional value of risk on a daily basis. Okay. So this now produces us some statistics and metrics that not only can we just visualize here for Microsoft, but we could start comparing it against other stocks. Well, if Microsoft performed this, how did NVIDIA do, or how did Apple do, right? And then on a relative basis, we could see the average returns, but we could also compare it to the standard deviation of those returns. How much variability and risk do we have from a day to day? And then we could use that ratio to compare the average return for each unit of risk that we're taking on. So now that we have this, one question could be, well, if we see these average returns and we see, how it's doing, how did that measure up to the rest of the market? Was it doing better than, because you could do a very diversified portfolio of, let's say, SPY, which is the S&P 500, and in a diversified portfolio, you obviously hedge away some of that systemic risk, right? Because Microsoft has more firm-specific risk than S&P 500, which is diversified between lots of different companies and different sectors and industries. So, how did that perform versus the rest of the market? Because even if it looks good on eyeballing it, how good is it if you could achieve the same thing just being in S&P 500, or if you were in the S&P 500, maybe it was just as good and with less risk. So let's compare that on a relative basis. So I'm going to slide up here, and we're going to go to this tab, average daily returns, and we have these filters for last 15 days, 30 days, and 90 days. And we could filter out based on the amount of days that were positive versus negative. We could look for certain returns above, a certain amount, and standard deviation. Or we could, if we look at it here, we could also do it on a relative basis versus SPY. So here's the benchmark, SPY. And what we're looking at here, if we pick above SPY, what this will say is, well, we were looking for more positive days than the rest of the market, S&P 500. So if the S&P 500 was up 6 days out of 60% out of the last 15 days, we're looking for stocks that did even better than that. So let's say like here, I'm going to put in SPY. So if we put in SPY, we see that it was up 60% of the last 15 days. So 60% of the last 15 days were up days. So let's say we want to do better, something like above 60. I'm going to unlock that, and we're going to look at that it's above SPY. Okay. So all the stocks that performed higher up days or more up days than SPY. Okay. So now we have this list. We could also narrow it down, because even if we had more up days, right? Like even if we had more up days, you could see that the returns could still be negative, right? Because here Tesla was up 60% of the time, but on average, you could still have negative, because your down days could have exceeded the returns on your down days could have exceeded your up days. The stock's returns are not equal every day. You could have an up day of 3%, but a down day of 5%, and an up day of 2%, and a down day of 10%. So what about the average returns? Did it outperform SPY? So SPY on average gained 0.3%, right? So 0.3% on average per day over the last 15 days. So what if we looked for stocks that averaged higher than that? So we could go back up here. And remember, right now I'm just filtering 15 days. We can do the same thing for 30 days and 90 days. Let's just stick with the most recent history, and we'll say on average, we want to be above the benchmark. Click on that. So now we have a smaller list, but still 2,000, where now we have both the frequency of up days exceeded the frequency of up days in SPY, and the average returns over the average daily returns over the last 15 days exceeded SPY. So this shows us that on a relative basis, these were indicating strength, that they were a stronger performer than SPY. And we could keep going further and saying, well, that could be the case, these two. But let's keep going further, trying to see where maybe the volatility of the returns were lower, right? So the volatility of returns in SPY, it's a diversified index, S&P 500. So the volatility of that shouldn't be as high as, a single stock. But maybe, we could find something that is lower. So here, what we want to do is use this ratio where the Sharpe ratio is higher than the SPY Sharpe, right? Where our average return divided by the standard deviation is higher, which shows that we got more return for each unit of risk. Okay, so let me see. So we're going to do the Sharpe above SPY. So here, now we narrowed it down further to 1,000. So now we have stocks that in the shorter term, or the most recent history, have displayed strong performance on a relative basis. Okay, so on a relative basis, they showed a strong performance when we compare those metrics to the rest of the market in SPY. And then we could go if we wanted to go out longer term and say, like, what about an intermediate? We could do the same thing. Look for the last 30 days, average returns, maybe Sharpe, and see. So now we narrowed it down to 535 and so forth. So you could see here that quickly we could narrow down candidates to find those securities that on a relative basis have outperformed the market using these metrics. All right, well, so I'm going to stop right there. We covered, I think, this part at this point.
All right, Dee, that was another excellent morning webinar. Thanks, everyone, for those who joined today. Great job, as always, Dee. We will have a show tomorrow, regular time, 9 a.m. Any last commentary for the Chameleons, Dee?
No, thanks for joining, everyone. Stay safe out there. Hope you have a great trading day.
All right, have a great day, Dee. We'll see you tomorrow. Thanks, everyone, again for joining the Market Chameleon pre-market webinar series. And I will check on the emails, Rob. I don't know what happened. It looked like it went out to me. I did send it earlier, though MailChimp doesn't seem to be a great service. I apologize about that. Everyone have a great day. Remember to follow us, like us on all the platforms. Thumbs up on YouTube, always appreciated. Everyone have a safe day and great trading out there. Have a great day. Bye.